All right, so we're gonna be doing the second section of depreciation. So yesterday we took a look at what depreciation is. So the second section is going to be looking at a second costing method for double declining. Okay, which is called double declining, which is a costing method you use to calculate how much depreciation you need to devalue your assets over time. So once again, you're going to be identifying these 5 categories, right? But this time, the 5th one is given because we're learning double declining today, okay? So we need to identify the asset cost, the estimated useful life, or estimated units produced. Okay, we need to also identify the salvage value or residual value and the date that we place into service. Okay, so once again, we're doing double declining, also known as accelerated. Okay, so let's dive into the formulas. So when we talk about accelerated or double declining method, right? How we're calculating this is that we are looking at an item, right, or a fixed asset that we tend to use more, very, very frequently or more often in the beginning of its life. Okay, so for instance, technology, right? Usually, when you buy something, right, you have an intention for it. But for example, let's say you buy a laptop for school, right? During the time of school, you're using it on and off 24/7 a day, and so on and so forth, right? You use it for the first couple years, and you're using it so much because that's what that's what it's meant for, right? It's meant for you to use it for schooling purposes. But once you graduate, right, then you tend to not use the computer as often. And then eventually, a few more years later after that, that computer is done for because the processors is old, the mechanics is old, the operating system's old. Everything becomes obsolete, right? And that's the idea here, is that when we tend to buy things like machinery or technology, right? The idea here is why we depreciate it twice as much is because we usually use it more often in the beginning of its life than towards the end of its life. Okay, so in this case, the reason why we say double decline is because we're actually depreciating it twice as much through its entire life. Okay, so the formulas that we're going to be looking at here are going to be the depreciation basis, which is going to equal the beginning of the year's book value. Okay, beginning of the year's book value. All right, so that means every single time we calculate our book value at the end of the year, that becomes our beginning of the year. Okay, so in this case, every year, your depreciation basis will change. Okay, it'll be a start off with a different number. Okay. Second thing that we're going to be looking at is going to be what's called our depreciation rate. So in units of production, we call that a per unit rate. You can refer that as depreciation rate as well, but in this case, it makes more sense if it's a per unit rate, because what you're figuring out in the units of production is how much is it going to cost you for every item or unit that you produce. In this case, the depreciation rate is going to function differently. This time, we're looking at on spreading the cost amongst its lifespan. Okay, lifespan meaning the estimated useful life. So this one is going to be time sensitive, all right? So in this case, it's going to be 1, so 1, like the number 1, divided by the estimated useful life, and we're going to multiply it by 2 because we're going to depreciate it twice as much, twice as fast, okay? So in this case, the depreciation rate is going to be 1 over the estimated useful life times 2. All right, hence the word double declining. And then, of course, depreciation expense is going to be the rate times basis, or basis times rate. And then your accumulated and book value, these two formulas are going to stay the consistent throughout the methods of the depreciation methods, right? So the accumulated depreciation is going to be previous year's accumulated depreciation plus current year's depreciation expense, and then the book value is going to be the asset cost minus accumulated depreciation. Okay, so those ones are set in stone. They don't change. Nothing's different about it. It's just the first three that is going to be different. Okay? So let's take a look at an example here where we buy a machine. All right, and we're going to be journalizing and recording the first year's expense. So in this case, we bought a machine that's worth $15,000, has a salvage value of $2,500, and the useful life is 5 years. Even though you had a number of units that it could produce is 10,000, this is double declining. We're going to choose to pick the estimated useful life versus the number of units it can produce. Okay? And of course, the date we place into service is January 1st. So let's go ahead and identify each of the following. So number one, let's figure out what the depreciation basis is. If it's supposed to be the beginning of the year's book value, right? The day that you purchase your asset is going to be your book value, because in this case, right, even though we understand it as fair market value, the minute you acquire it and you put it in your books, it becomes book value then, okay? So that means if it's supposed to be the beginning of the year's book value, if we have never depreciated the asset in the first place, that means the book value is going to equal your cost of the asset for the very, very first year. Okay? So in this case, $15,000 is what I'm going to be putting here. So now I need to solve for the depreciation rate, which is going to be 1 over the estimated useful life times 2. So in this case, right, we have an estimated useful life of 5 years. So we're going to spread the cost evenly amongst the total lifespan of the asset. So in this case, it can last you for 5 years. So that means 1 divided by 5, which gives you 0.2% or 20%, right? And since you're going to multiply it by 2, it's going to go from 20% to 40%. So that's exactly what we're going to be looking here is. That means you're going to depreciate the value by 40% of the asset, okay? Because it's going to depreciate twice as much. So in this case, right, 40%, right, and to solve for our depreciation expense, we're going to take basis times rate. So in this case, what is 40% of 1,500 or 15,000, okay? 40% of 15,000 is going to give you $6,000. Okay? So once $6,000 is there, the accumulated depreciation, once again, because it's the first year, it's going to be since there's no previous years, it's going to just equal the current year's depreciation expense for $6,000. And then now we need to solve for our book value. So what is my book value? It's going to be the cost of the asset of $15,000 minus the accumulated depreciation, which in this case is $6,000, which is going to leave us with $9,000. Okay? So that's the first years of depreciation. Now, what happens when I need to continue on for the second year? Since the second year, right, we're going to start the formulas all over. So in this case, the depreciation basis for the second year is going to be the beginning of the year's book value. So if at the end of the first year of depreciating, right, your book value is currently $9,000, your ending becomes your beginning, right? Because if it's the end of year 1, it becomes the beginning of year 2. So in this case, we're taking this $9,000 and we're plugging it into the depreciation basis, okay? So once you plug it into the depreciation basis, then we need to solve for the rest of the columns. So here, again, the rate is going to be 1 over 5 times 2, which gives you another 40%. So then you put the 40% there, And now you need to figure out what 40% of $9,000 is, which in this case, when we calculate it, gives us a total of 3,600. Okay, so then 3,600 plus the previous accumulated depreciation of 6,000 gives us a grand total of 9,600. And then when we solve for the book value, it's going to be 15,000 minus that 9,600 to give us 5,400. All right, then you're going to rinse and repeat until you reach the end, okay? Now, here, I want you to note this because it's very important. If you're choosing to depreciate twice as much for its lifespan, do you think it's going to last till the 5th year? If you're depreciating it twice as much? In this case, sometimes it can, but sometimes it won't. So in this case, 3rd year, okay, we get the book value to be 3,240. 4th year, now we're down to 1,944. So in this case, right, our book value needs to be 2,500. If you remember the rule, your book value cannot fall below salvage value. So for instance, right, even though we're on 4th year and we depreciate it, right, we depreciate it twice as much, so therefore it left us with 1,944. You can't have that. It has to be 2,500. So in this case, what do we need to do now? So if this is the case where you're trying to figure out what your numbers are going to be, right? So therefore, we need to work backwards because we know for a fact that the salvage value must equal the book value, right? Or the book value must equal salvage value. So in this case, we need to work backwards. So we could plug in this, right? We know for a fact that our book value should end by the 4th year to be 2,500, okay? So now we need to work backwards, right? What is backwards when we are going to solve for our accumulated depreciation? Well, just like regular math, right? If A plus B equals C, then that means B can equal C minus A, right? That's the same idea that we're going to apply here. If you have one or two of the answers, you can solve for the missing variable. So in this case, right, we know that the book value is going to be your asset cost minus accumulated depreciation. Well, if we know what book value is and we know what the asset cost is, you're able to work backwards to solve for the accumulated depreciation. So if my book value at the end of year 4 is 2,500, you know your asset cost is 15,000, and we know if we're going to subtract it out to get our accumulated depreciation, let's plug in and solve for the answer. Well, in this case, you're going to take your 15,000 minus that 2,500, and you're going to get the answer to be 12,500. Okay? So then again, we needed to work one more formula backwards because our goal is we need to know how much we're going to be needing to depreciate for year 4. So in this case, how do we solve for year 4? Well, we know that the accumulated depreciation is going to be the previous year's accumulated depreciation plus the current year's depreciation expense. We know that much. So, once again, plug in what you know. If you know that the accumulated depreciation is going to be 12,500, right? And you know what your previous year was, which is going to be 11,760. What's the difference between the two? And you'll get the answer for your current year's depreciation expense, which in this case is going to give you your $700.40. So that's the number you're going to be plugging in here. So there's all of your answers. So in this case, the book value is 2,500. Your accumulated depreciation is now 12,500, and your amount to depreciate for that 4th year is going to be $740. So in this case, right, once your book value falls below salvage value, it cannot do that. So in this case, for the 4th year of using this machine, you have to only depreciate $740 that year. Okay. Any questions here? No? Okay. So here's what you're going to notice. The estimated useful life is less than 5 years because the idea of if you're going to be utilizing it twice as fast, of course it's not going to last to the end of its life expectancy, right? Because you're pushing it over its limit. Second thing is that your book value, or in this case, your depreciation basis, is going to be essentially your book value that you solve for every year, except for the first one, because the first one's going to just be your asset cost. But this is why we need to start with our depreciation basis. Is going to be the beginning of the year's book value, okay? What you're going to notice is once you solve for the rate's going to stay consistent. And of course, because of the basis is being different times the rate, you're going to get a different depreciation expense every year. Okay? And last but not least, when we solve for this, at least the number one rule is that the salvage value, the book value, is equal to salvage value. Okay? So let's go ahead and journalize that first adjustment entry that we need to do for the first year. So in this case, we have our table down below. We solved for $6,000. So that's what you're going to do. Depreciation expense and accumulated depreciation for $6,000. Okay? And then for the second year, right? Same thing. Here's your table. We already solved for it. Your depreciation expense for the second year is $3,600. Okay, so again, what you're going to notice is that every year your depreciation or adjustment entry will change every year because of the way that you're calculating it. Okay. So we also talked about partial years in the previous lesson, right? Partial years does matter for this one because when we're looking at calculating the depreciation and we're using it twice as much, we're comparing it based on its lifespan. So in this case, yes, this asset is going to be time sensitive. So partial years is something that you need to learn. Now, for instance, this example here, we bought a machine worth $10,000 with a salvage value of $2,500. It has an estimated useful life of 5 years. However, the date that we placed into service was October 14. So how many months are we going to depreciate it for, if assuming that you're going to depreciate at the end of the year, December 31st? In this case, right, we have to figure out the rule. Is it within the first 15 days or is it in the last 15 days? In this case, it fell on October 14, which is right before the first 15 days. So in this case, we will be depreciating it for the month of October. Now, if you're planning to depreciate the end of the year, December 31st, how many months are you actually going to depreciate this for? We got it for October, we have to do it for November, and we have to do it for December. So in this case, we need to calculate for the first year, you're only going to depreciate it for 3 months, right? We have to treat our assets like they are our babies. So if they're born on October 14, you're going to treat this saying that this baby is 3 months old, all right? Not a whole year, okay? So we have to take that into consideration. Let's go ahead and try to solve for the problem. So in this case, depreciation basis, once again, is going to be your asset cost for the first year. So in this case, it's going to be $10,000, right? And then the next one is going to be depreciation rate, which is 1 over the estimated useful life times 2. So once again, we have another 5 years. So that's 1 divided by 5, which is 0.2 times 2. It's going to give you 40%. Now, if you go ahead and multiply across for the depreciation expense, you're going to take $10,000 and you're going to multiply it by the rate, which is going to be 40%. So in this case, your answer here is you're going to depreciate for $4,000. Now, in this case, right, because we're looking at time and you're going to depreciate it, this $4,000 is because you're depreciating for the whole year. Okay? In this case, that's not what you can do. You're not treating the baby like it's a whole year's old when it's really only 3 months, right? So how do I figure this out in my depreciation expense? Well, if I know $4,000 is for the whole year, how can I convert it to reflect that I only want to do it for 3 months out of 12? Well, there you go, right? Exactly how I said it. I need to figure out how many months am I actually going to be depreciating it. In this case, I'm going to be depreciating it for 3 out of 12 months, okay? 3 out of 12 is also equivalent to a quarter of the year, right? If it's a quarter of the year, then go ahead and do your math. What's 4,000 divided by 4? It's going to give you $1,000, okay? And there you go. You're able to solve that yourself. Another way that you can also solve it too is, well, you can divide the whole thing. So $4,000 divided by 12 months, right? Because then that's going to give you a monthly depreciation. You multiply it by the 3 months that you are active with it, which should give you 999.999. So that should round up to $1,000. Okay, so in this case, right, that is how you're going to treat this, because in this case, for the first year that you're depreciating it, it can't be for the whole year. It can only be 3 months out of the year. All right, so that's how we need to figure out. Now, the best way to do it too, if you're using Excel, just go ahead and put it in directly as 3 divided by 12. Okay, so in this case, you're going to do your depreciation basis of 10,000 multiplied by 0.4, which is percentage, right? Then you're going to multiply by 3 and divide the whole thing by 12. That's the same exact answer you're going to get, is $1,000. Okay. All right, so again, when you put your asset into service in later in the year, and it's not January 1st, you need to consider that the first year of depreciation, you're going to be calculating partial years. Okay. All right, so then there you go. And then for the first year, you said it was $1,000, so that's exactly what you're going to do. You're going to depreciate for $1,000. Okay. So chapter review, right? We don't need to go over depreciation because that was yesterday. So in this case, the key review for this one is the double declining formulas. This is what happens when book value falls below salvage value. You need to convert those formulas into a way where you can solve for those answers. And you have to know that double declining, the way, the purpose, and the purpose of this using this method is because you tend to use the asset more in the beginning of its life more than later, right? So that's why you choose to depreciate it twice as fast, because you're going over its life expectancy. Okay, so there you go. And here, number 1 rule is book value must equal to salvage value. Okay, so, and since there's no questions in regards to that, let's go ahead and dive into the exercise, and maybe your questions will come out then. Okay, so let's go ahead and look at question 1 through 3. Okay, very similar to the previous exercises we've done, except different scenarios. So number one, okay, you decide to purchase a cash register for $300 with no salvage value. It has a useful life of 5 years and can print up to 5,000 receipts. Okay, and of course, you put this cash register into service as of January 8th. Okay, so let's break down and locate our variables. Okay, first off, what did we buy? We bought a cash register. Okay. How much did the cash register cost?
$300.
$300. What is the salvage value?
No salvage value.
There's no salvage value, so it's 0 here. Okay. What is the estimated useful life?
5 years.
It's got 5 years on it. And when did you place into service?
January 8th.
January 8th. So in this case, when do I just start depreciating this asset?
January 1st.
January 1st. And assuming that you are going to depreciate the end of the year, December 31st, we will be depreciating for the first year a full 12 months. Okay. So in this case, right, what's my depreciation basis?
The formula for depreciation basis would be, let me look at it.
Isn't it your asset cost?
In this case, the very first one
Oh, the book value.
is exactly. It's going to be the book value. But right now, this is my first time depreciating it. The book value is going to be whatever I purchased it for. So in this case, my asset cost is going to be my book value. Okay? $300. All right. What's my rate going to be?
The rate's gonna be
It would be the 40% too, wouldn't it? Because it's 5 years. 1 divided by the 5 is 0.2 times 2 would be 40%.
Excellent. It'd be 40%. Okay. So if I'm going to depreciate it for a full year on the first year, how much is my depreciation expense going to be?
depreciation basis times 300 times 40%.
Mm-hmm.
It would be 120.
So, $120. Good. Go ahead. So
the accumulated depreciation would be previous years, which is, it was useful for 5 years. So then current year's depreciation, which is,
So there wouldn't be any accumulated yet.
yeah, because it hasn't, you haven't used it yet.
good.
So it'd be 0 then, because there's no accumulated depreciation yet.
Well, it's accumulated. It's previous year's accumulated depreciation plus current year's depreciation expense.
So it would just be 120 because there was no previous year.
Good. All right. So how do you solve for your book value?
Subtract accumulated depreciation from depreciation base.
Not depreciation basis. That's the mistake that every student makes.
Yeah, I did it again. Okay.
Yeah, the cost of asset minus the accumulated depreciation.
Correct. So in this case, my current cost of asset is $300. Right? What is my accumulated depreciation that year? 120. So what's 300 minus 120?
180.
180. Good. So what about year 2? What's my depreciation basis for year 2?
Starts at the 180 because it's the book value from the year before.
Correct, because in this case, if I end my first year with a book value of 180, what does it mean at the beginning of the year? It means, well, if it ended on December 31st at 180, what does it mean to me in January 1st of the following year? It means that my book value is going to be 180.
Yeah.
Right? Good. So, what's my rate going to be?
It'll be the
The 40%.
Yeah, 1 divided by 5 times 2, which is that same exact 40%. So in this case, what happens to the rate? It's going to stay...
It stays the same, right? Or does it? Yeah. Oh, it stays the same for the whole thing, cause yeah.
Yes, because the formula is still going to always be 1 divided by 5 times 2. So in this case, my rate, I already know, will always be constant. It will be 40% all the way through. Okay? Now in this case, right, because I have a new depreciation basis of $180, what's 40% of that?
$72.
Okay, good. All right, if it,
Cumulative would be 192.
so in this case, we're going to take my previous of 120 plus 72, which is my current, right? Give you 192. So what's my book value going to be at the end of year 2?
Let's see. It's 300 minus the 192.
Mm-hmm.
108.
Good. 300 minus 192 will give you 108. Right? So let's continue on. What about year 3?
Move the 108 down because that's the basis.
Mm-hmm.
That's so depreciation expense would be 4320.
Okay. Accumulated depreciation for year 3.
23520.
Book value,
6480.
64. Good.
And next year's would be 6480.
Mm-hmm. Correct.
After that, depreciation expense would be depreciation basis times the unit rate, so it'd be 64 times 40%.
Mm-hmm.
2592.
Accumulated depreciation would be the cost.
Previous years.
So the previous years was what, 64 minus current year. So it'd be 64 minus 20.
Not 64. You're looking at the wrong column.
Oh, it'd be 108 minus 64.
No. You're looking at the wrong column again. So look at the accumulated depreciation.
Okay. So it'd be 235
Yes.
minus.
Not minus.
Oh, plus 25.
Right. Accumulated, right?
Yeah.
If we understand accumulated, it literally means that you're adding up, right?
Right.
So in this case, that's how you can make a reference, is that you're adding up all the depreciation expenses over the years. So that's it's the hence the word accumulated depreciation. You're adding all the accumulation. So in this case, how much have you already accumulated at the end of year 4?
261.12.
Good. And so that will leave your book value to be
It would be the cost minus the accumulated depreciation. So it'd be cost
3888.
88.
3888. Good. So let's just go ahead and do one more for the last year of its life. So you got 3888. %40 of 3888.
Uh, it'd be 15. No, I'm tripping. It'd
Yeah,
be
15.
15 plus 38.
No,
No,
no, no,
yeah,
no, 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 no.
I'm tripping. It'd be 15. Yeah.
Yep, 15. Yep, good. 1555. So your accumulated will become
Would be it'd be 1555 plus 261,
mm-hmm.
276.
Mm-hmm. So what would your book value be at the end of the 5th year?
So 276 minus
300.
324.
I think it's 27. Oh, yeah, you're right, 24. $23.33. Right? Now, can I continue going on for a 6th year?
No, you can't.
Why?
You could. You could, because it would not be below the Wait, would it?
You're on the right track. That's correct. Yes, you can keep going because you're right. My book value has not fallen below salvage value. But let's actually really consider this, right? You have a cash register. It's been 5 years since you used it. Now, if you're using it twice as fast, right? What are the chances that the buttons are still functioning? What are the chances that the receipt tape paper roll is still running?
It's a
What are
low chance.
It's a low chance because you used a lot out of it, right? Because that's the purpose of double declining is you used it to the point past its life expectancy. Even though it did reach its 5th year, what are the chances it's still working? And it's only worth $23. Is that $23 worth it to keep pushing it forward?
No, you might as well just get a new one at that point.
Exactly. And you're only going to lose $23 out of it. In fact, I don't even think you're going to get any money out of it because who would want to buy a 5-year-old used cash register, right? Anybody can agree that they're better off buying a brand new one. You might be able to get chump change or what do they call it? Scrap metal. Mm-hmm.
It's not even worth it at that point.
Exactly. You probably can get $10, $5 out of it, which is it's not bad because you didn't lose that much, right? You only lose
Right.
maybe like $20 out of it, right? But
Still got
still,
value.
you still got some value out of it. Now, we'll talk about what happens when you choose to get rid of the asset without getting any money out of it. Like, you don't sell it to anybody, you just go to the recycle bin and just dump it in the trash. What are you going to do to take that off your books? In this case, you're right. Is it better that we keep it running for one more year, or you're better off buying a new one? In this case, you're probably better off buying a new one, and $23 is not going to hurt your business as much as it is if you were to throw away a $1,000 machine, right? That has a value of $1,000. So in this case, that's the situation. So if you can continue to keep going for a 6th year, but it's not worth it. Okay? So let's go ahead and practice journalizing our adjustment entry. So in this case, record the adjustment entry for the 1st year of depreciation. So in this case, how would I journalize if I am depreciating it at the end of the year, December 31st?
And then you're December 31st. That's after. So it would book. Do we write just the book value of what it was after the 1st year?
In this case, no, because we're not looking at book value. We're looking at how much I have to write off my books for the first year.
Oh, so we'd write, well, the accumulated depreciation was $120, so you minus 120 minus 300, right?
In this case, no, we're not. We're when I'm journalizing something, what was the transaction at hand? What did I do to cause my book value to drop that far?
By using, by,
By using it. What term do we use to use it? What was the whole premises of this chapter? What did I call this chapter? You depreciate it, right?
right,
So in this case, for the very first year, how much did I depreciate it to cause my book value to drop that low?
oh, 40%, right?
Oh, okay, 40%, which was a total of
120,
120. Good, right? That's what I depreciated for. So in this case, how do I journalize that?
you debit, um, yeah, you debit 120.
Good, right? So you told me you're going to debit 120. That's correct. Okay. Now, what account am I going to be using to represent that I am changing the value of my cash register?
Inventory.
Not this is not inventory.
Oh, I mean, oh, the depreciation
Depreciation. Good.
value.
Not value. What's the key word on my table?
Depreciation expense.
Depreciation expense. Good. So in this case, that's what I have to recognize because that's what I've been solving my entire time right here, right? What was the first year's of depreciation expense? Well, I depreciated for 120, which caused me to drop my book value to 180. But the purpose of this transaction is I need to devalue my asset. How do I do that? I have to record a depreciation expense. So in this case, that's what I need to do. So I'm going to have a depreciation expense. Okay? Now, what's the rule of thumb for journals? My debits must equal.
Your MA equal your debits must equal your credit.
Good. So that means I need to create a credit account to represent my to represent that this transaction went through evenly. So in this case, right, if I had a depreciation expense for 120, what's my contra account going to be? What's my credit account going to be? I kind of gave you the answer. What is my credit account going to be?
Oh, you're gonna credit for, yeah, it'd be the same thing. Depreciation
What kind of depreciation?
expense. Depreciation expense. It's the same thing.
No.
Or depreciation.
Accumulated, isn't it?
You need to credit the accumulated, right? Because you need to find a place to rack up all your depreciations, right? So you can put it against the actual asset that you're trying to depreciate, right? So in this case, we use a contra asset account. This contra asset account is going to be directly related to that fixed asset. Because the rules of the historical cost principle, right, says that you cannot devalue your asset. So how do we go around that? We create a contra account to be able to reflect that we are devaluing our asset by using it. So in this case, the accumulated depreciation is going to be what you're going to be crediting. Okay. So there you go. That's for the first year. Let's go ahead and do
So
this.
it's gonna be like that for every time we journalize. It's gonna be the same thing then. Depreciation
Mm-hmm.
expense.
Correct. Correct. So then for the second year, right?
Is there any area where it'd be different though?
What do you mean?
Like where we'd no, because it wouldn't be, because if we're doing the same thing, it's, yeah, never mind.
In this case, no, there will be no reason that you would change your journal entry. The only thing that you're changing is the debits and credits, because every year in this case, right, What happened to my second year? How much did I depreciate it?
72.
You only depreciated it for 72 because of the book value was already 180, and you're taking 40% of that, which only gave you 72 for the second year. So in this case, the only difference that you're going to be noting here is your debits and credits. So in this case, you're going to be debiting your expense by $72 for the second year. Okay. All right.
Right.
Okay. All right. So that's the first one there. So let's go ahead and take a look at the question 4 through 6. Okay. All right. So in this case, question number 4, you end up purchasing a computer for $1,988, which includes all fees. Okay. And of course, your salvage value for this computer is going to give you $200 left. Okay. And of course, the estimated useful life is 5 years, and you put this computer into service on August 25th. Okay. Assume that the adjustment entry is going to be at the end of the year, December 31. Okay. So let's go ahead and what did we buy?
Computer.
We bought a computer. How much did the computer cost me?
300.
1988. Okay.
Oh, I'm tripping. I'm thinking about the last. Never mind.
Yeah.
I thought it was connected to something.
No. In this case, this is another example. So in this case, we bought a computer for 1988. Okay. How much was my salvage value?
200.
200. Okay. So we have a threshold here. And how much was my estimated useful life, or how long?
5 years.
You got 5 years on it. Right? And last but not least, what date did you place this into service?
September 1st.
Oh, in this case, August 25th. But yes, you're going to treat it as if you're going to depreciate it September 1st. Because it fell after the 15th, right? The first 15 days. So in this case, right? How much would it cost me if I only need to depreciate it for 6 days? That's not worth to depreciate for only 6 days. So you're better off to just take that 6 days and shove it into the very first, into the next month, right? So in this case, we're not depreciating as of August. We're going to depreciate as of September, okay? All right, so the first year, right, what is my depreciation basis going to be?
The 1988.
Then 1988, because the first year, right, is the beginning of the year book value, which is going to be whatever your asset cost is. So in this case, 1988. Right? What is going to be my rate?
Since it's 5 years, it's 40% again.
Right? You still get that 1 divided by 5 times 2, right? Which is going to give you that 40%. And what do we know about the rate?
It stays the same.
It stays the same, so I can go ahead and drag those all the way down. Okay? All right, so then what about the depreciation expense? What's it going to be for the first year?
It's $795.20.
Okay, let's see. Let me do my equal round here. 1988 times 40%. It's going to give you $795.20. Now, is that true?
No, because we only used 3 months.
Let's count again. If you're going to start depreciating September,
4 months.
October, November, December. That's 4 months, okay? So in this case, right, this is for the whole year. We can't treat my computer like it's 1 year old when it's only been 4 months. So how do I adjust my depreciation expense to reflect that I'm only depreciating it for 4 months out of the 12?
leave the C12, but you multiply it by, it's 4 months, so you'd multiply it by 4/12.
Good, excellent, right? Because we only need to know how much is it going to be for 4 out of the 12 months. So you can just directly put in multiply by 4 divided by 12 instead of doing 0.00333333, right? How many threes can you put in there to make sure that you get the accurate answer? It might be impossible, so you're better off just going ahead and just putting 4 divided by 12, and Excel, even a calculator, will help you figure that out. So in this case, how much is going to be my grand total for the depreciation for the first year? 26507. Now, if that is too confusing for you, right? Let's go ahead and see another way that you could solve for this, okay? So let me go ahead and redo that. What was it again? It was 7595. Okay, I'm gonna put it right here. 7595 and 20 cents, right? What can I do to be able to know how much it's gonna cost me for every single month? In this case, it's gonna be $66.266666 per month. And if I used it for 4 months, that will get me my 265,066, which if you round up will give you that 26507. So that's another way that you could solve it too, if you can't, if you are getting confused on how to do the math portion here. Right? So down below, what I did was I took the depreciation for the whole year, divided by 12 to give me my monthly depreciation. And then what I did from there is I multiplied it by how many months I actually used the asset. Right? So again, I'm going to do my formula here so you can remember that it's going to be 4 divided by 12. Okay? Comma 2. All right? So then therefore, my accumulated depreciation for the first year is going to be the same as my depreciation expense. So what's my book value going to be now?
1722.93.
So we're going to take my 1988 and we're going to subtract the 26507 to give you that 1722.93. Okay. All right, so let's keep solving. What's the second one? What's my depreciation basis for the second year?
1722.93.
Good.
Times the rate, and it would be the full year, so it's 689.17.
Good, for the full year. All right, because this time, right, if I ended my depreciation for the first one as December 31st, and I'm continuing to start my assets as of January, and then depreciating again at December 31st, that was a whole 12 months, right?
Yeah.
So in this case, you're going to depreciate for the full year for the second one, okay? Which gave you $689.17. So what is my accumulated depreciation here?
It would be 954.24.
Good. Okay. So what is my book value at the second year, at the end of the second year? So 1988.
1,033.76.
Good. So 1988, and you're going to subtract your accumulated of 954.24, and you're going to get 1,033.76. Okay. All right, let's continue. You're at year 3. And carry that over. What's my depreciation expense for year 3?
$413.50.
$413.50, which will give me accumulated depreciation of 13,6,7,7,4.
Yeah, 1367.74.
Okay, good. All right. So what's your book value here?
620.26.
6/20/26. So let's continue using it for year 4.
Depreciation expense is 248.10.
Good. Depreciation, accumulated depreciation. Okay, you can get 84. 483.
Yeah, 1584.
1615.84. Good. So then book value
372.16.
372.16. All right, we can keep going for the 5th year.
It'd be so it'd be 317 times 40%. I'm 372 times 40%.
Yes.
148.86.
Good. 148.86. So the accumulated depreciation 1615.84 plus 148.86.
1764.70.
Okay. So what is going to be my book value at the end of year 5?
223.30.
Okay, good. So, question to you guys. Can we continue to use our computer for another year?
No, because salvage is 200.
Yes, and wait.
Yes, because your book value is only 223.
Plus, the first year we only claimed 4 months.
Correct.
So
We
8 months left.
it's only 4.5. Basically 4.5, right? It's 4 years and 4 months. So in this case, we haven't even reached its lifespan expectancy. So right now, we still got 8 months left to depreciate on it. So technically, yes, we can depreciate for a 6th year. Okay?
But since the salvage value is going to end up, we have to do it the backwards way that you did, right?
In this case, let's go ahead and solve and then see how far we have to work back. Okay, so if I go ahead and put in my depreciation for that 223.30, what's 40% of that?
89.32.
89.32. Whoa, that was too much. Oh, okay, because it's I switched this over. I gotta put this back as 0.4. Nope. There you go. So that should be okay, $89.32 accumulated will bring you 1850,
402.
which will drop your book value down to $133.98. So in this case, I do need to work backwards. Okay, so let me strike through this real quick, and then we'll go ahead and work our way backwards. Okay, so strike through. Okay, so in this case, let's go ahead and do our calculations here. Okay, so if we know what book value is, right? We know that book value needs to be how much?
200.
We know it needs to be 200, okay? Now, how do I solve for my accumulated depreciation using the formulas I know now? Okay, so here's one formula we know, right? Book value, so BV, book value. Okay, I'm struggling here.
BS.
There you go. Book value, all right, equals asset cost minus accumulated depreciation. Okay? So, how do we solve for that? If we know 200 is going to equal book value was 1988 minus AD, right? How do we know how much we need to solve for? Do your math. How do you get to 200 from 1988? You can even do the math here. 1988 minus 200. That means your accumulated depreciation is going to be 1788, right? So now we need to solve for our next one, which we know that the accumulated depreciation is going to be your previous accumulated depreciation plus your current year's depreciation expense, right? So in this case, we know what my accumulated depreciation is. It's 1788. We know what my previous is, right? Which is going to be the 1764.70 plus X or plus E, right? So what is going to be my total here? I can do my simple math right here. 1788 minus 1764.70.
2330.
2330. And that's it for the 6th year. Okay? So that's doing it working backwards. Now, for you guys who can identify this much more quicker.
More time, because I didn't really get it.
Okay. Which one? So starting all over again?
No, just doing it backwards. Yeah.
Okay, so if we know book value needs to equal salvage value, right? So in this case, what is my salvage value?
Salvage value is which one? 200.
200, right? So that means that is my ending balance right there. And if I know, right, the formula that I use to solve for book value is going to be my book value is equal to my asset cost minus accumulated depreciation, right? We know that.
1988 minus 200.
I'm sorry?
So it'd be 1988 minus 200.
Correct. To get your accumulated depreciation.
Right.
Right? So then now I get 1788. Now the next formula that we used to solve for accumulated depreciation is accumulated depreciation is equal to previous year's accumulated depreciation plus current year's depreciation expense. So that's the formula I put right here, right? Accumulated depreciation is equal to previous accumulated depreciation plus current year's depreciation expense. We know for a fact that we have our accumulated depreciation, right? It was 1788. And we know what the previous year's was because it was 1764.70.
Right.
So how do I solve for my depreciation expense for that year?
You just
Look at the formula here, right? 1788 is going to equal to 1764.70. What do I need to add to the 1764.70 to equal 1788?
the cost
Okay. Formula for accumulated depreciation is your previous year's accumulated depreciation plus your current year's depreciation expense, right?
Right.
We're trying to solve for the current year's depreciation expense because we don't know it yet. But we do know two numbers, right? We know that our accumulated depreciation that we solved for from the previous problem is 1788.
Um,
What's my previous year's accumulated depreciation for year 5?
89.
No.
I mean, not for year 5, 148.
Accumulated depreciation,
Not that. I apologize. 1764.
1764. Now, if my formula is going to be 1788 is equal to 1764 plus x, how do I solve for x?
Oh, you just do. Oh, so it'd be 23 because you just minus them.
Correct.
You factor in. I get it now.
Now, for those of you who saw this a lot sooner, right? If you knew for a fact that your ending balance is $223.30, and you knew you need to get to 200, you could have easily said, oh, my next expense is going to be for $23.30.
That would have been too easy then.
Exactly. And then you, instead of having to work backwards, you could have just worked forwards. But no, I wanted you guys to be able to know that because maybe you'll get a number that is not easily calculatable, and you might not be able to do it for the 6th year, right? You might have to do it for the 7th year. Especially with computers, right? We know even if we use it and run it to the ground, at the end of the day, it still can last us for more than 5 years, right? But it just depends on how well and you keep your computer in contact, okay? All right, so now let's go ahead and do question number 5 and 6 here, where we're going to need to journalize our entries for the 1st and 2nd year. So in this case, what is the adjustment entry going to be for the 1st year?
Oh, the adjustment entry for the first year is going to be 265.
265, right?
And we debit that.
What do we do? What account am I debiting?
You're debiting like depreciation expense.
Good, right? You're doing depreciation expense, and what's my credit account going to be?
Same thing. Oh, not same thing. It's going to be accumulated depreciation.
Correct. Okay, good. So I'm just going to go ahead and copy and paste this because, again, the journals are going to be exactly the same. The only difference is the number that you're going to be calculating and you're going to be plugging into your journal. Okay, so let me see which one. This line here. So that's the 1st year. What about my 2nd year?
Your 2nd year is going to be 689.
Excellent. Okay, and that's pretty much it. Okay, all right. Any questions in regards to this exercise?